Afternoon, ladies and gentlemen. My name is Zana Amdor. I am a professor of sociology. I'm here today filling in for my colleague, Professor Erasor Kadmase, who is still processing his his badge and so on. Apologies for the delay, but this was beyond us. I'm going to read the opening remark that was written by, again, my colleague, Yera's work. Invited guests, presenters, members of the FDL and the IPD research teams, ladies and gentlemen, good evening and welcome to this important seminar on addressing the debt crisis in the Global South, an agenda for recovery and sustainable growth that is co-sponsored by the Finance for Development Lab, the Initiative for Policy Dialogue, and the Forum for Social Studies, the Ethiopian think tank that I represent. Dear seminar participants, first and foremost, allow me to say a few words about the Forum for Social Studies that has served the Ethiopian nation and people for the last quarter of a century, celebrating its silver jubilee this same year. FSS is an independent non-profit institution dedicated to the cause of policy research and democratizing the policy space through informed public debate on the development issues and concerns. FSS is a reputable think tank well known for its high-quality research and informed dialogue outputs. Those of you who are keen on learning more about the Forum for Social Studies are welcome to check its website, fss-ethiopia.org. Ladies and gentlemen, finally, allow me to conclude my brief welcoming speech by recognizing and expressing my appreciation to the researchers and presenters from the two organizations, namely the Finance for Development Lab, FDL, and the Initiative for Policy Dialogue, IPD, that are behind the bridge proposal on addressing the debt crisis in the Global South that's being launched today. In the interest of saving time, I shall proceed right away to briefly introduce the four researchers speakers that are lined up to address this seminar. The program has changed a little bit, and therefore the names that I list now may not appear in the actual presentation. However, bear with me. We have today Ishac Diwan, the Research Director of Finance for Development Lab at the Paris School of Economics. He's also in charge of the Political Economy Program of the Economic Research Forum. We also have Martin Guzman, former Minister of Finance of Argentina, currently serves as a professor at School of International Public Affairs at Columbia University. We'll also have Vera Songwe, Senior Advisor at the Bank for International Settlements. And behind this report is also Joseph Stiglitz, a Nobel laureate in economics and professor at the Columbia University. In addition, the following two will act as discussants at the seminar. Aloma Yogada, a professor of macroeconomics and international economics at Addis Ababa University and a research associate at the University of London. And Patrick Njorge, apologies for the pronunciation, a renowned Kenyan economist and banker who has served as a governor of Central Bank of Kenya. Finally, on behalf of FSS and myself, I wish you all a productive and pleasant deliberations. As I mentioned earlier, the lineup has changed in the last minute. Without further ado, I invite the first speech, the first presentation, series of presentations on the paper. I'll give each speaker about 10 minutes. And thank you.
I can try to start, perhaps just to test whether the video conferencing works. Do you hear me?
Yes, we can hear you.
Thank you. Thank you. Martin, should I introduce or you want to jump to the presentation?
Yes. Start with you can start with the.
Okay.
Prediction.
Well, I want to start really by saying how sorry I am not to be with you. I have been really looking forward to being in Addis. I haven't been there for a while. I lived there between 2000 and 2005, and I have such wonderful memories. I only visited a few times. So I got stranded at Frankfurt airport, a terrible airport. So that's the only reason I wasn't there was bad weather in Europe. But video conferences save us, and Martin is with you, and I see many friends on the screen. So to start the presentation, I'll just say a few words, and then I'll give my time to Martin Kessler, who is with you, to give a more detailed presentation. This is a proposal that we've put together several months ago, the bridge proposal that we're going to present today. It's a new iteration that is richer. It has benefited from various consultations, including recently at a meeting that Martin Guzman, who is with us here, organized at the Vatican, which was very rich. And it has also, of course, benefited from his contribution and that of Joseph Stiglitz, making it a much richer, more conceptually based proposal. It's in our sense a proposal for our times. Every debt crisis or debt difficulty, that situation is different, and this particular one has 3-4 specificities which our proposal seeks to address. It comes after 2 decades of fast growth. It focuses on low and lower middle income countries, the 65 countries that benefit from concessional lending. It comes after 20 years of convergence, high growth, pushed by good policies after the HIPC, debt reduction, access to capital markets, especially access to Chinese credit after the 2000s, access to a large cycle of private credit. There was lots of liquidity in the market after the global debt crisis, but also favorable commodity prices and good policies, good investments in many countries that saw very high growth. And this all stopped with a series of negative shocks in 2019. The COVID, the Ukraine war, high fuel and food prices. And then came the fight against inflation, sending interest rates up and a sudden stop in capital flows, which really hurt these countries that were already experiencing balance of payment difficulties. They couldn't refinance their debts, and it generated instability, fiscal austerity, lower growth, and financing difficulties that many countries find themselves in. And so several specificities here. We have very different types of countries here. Some were actually growing well, using debt well. Others misused the debt that they borrowed and consumed it. So some end up with serious debt problems, and others have liquidity problems. And our work really is about differentiating between those different ills and the different type of remedies that are needed. Also noting that creditors are much more heterogeneous than in the past. And so we have a situation that requires much more adapted remedies, and that's what we present. We compare kind of simply talking about debt reduction or simply talking about continuation of the status quo where debt is refinanced by the international organization, and come up with a third way that we want to present to you today and hear your reactions. So I'm going to pass it on to Martin Kessler to take us into some details.
Thanks a lot, Ishac. Thanks for you all in the room and online for joining and for bearing with us with the logistical delays, and also to the UN teams for helping us setting this side event. So we can skip this slide. And this, so I think this is the overall context that Ishac presented, and so we can go ahead. Yeah, and so to recap, so it's like talked about the nature of shocks that occurred in the past 2 years, and that where low and lower middle income countries are structurally are at the receiving end, and with little shock absorption capacity. And so with the increase in interest rates, we saw that with relatively thin capital markets, with relatively low reserves, a lot of capital flows flowing out, a pro-cyclical effect of capital flows. In advanced economies, capital flows tend to be counter-cyclical to allow more space when there's a crisis. In developing economies, it's the reverse. And so that's a problem that the multilateral system, the global financial safety net, is trying to solve. And what we're going to argue is that it's not large enough to solve the problem as it is now, as acute as it is now. And so first highlighting the kind of the width and the breadth of the shock, and then if you the next slide. And then, as a result, so capital, there's a massive capital of outflows, which hit across all type of investment, both the foreign direct investment, private lending. In this, we are focusing on the effect of public debt, and so we're going to focus on the flows related to lending to governments. But you have to imagine that this is in a context where it's contractionary across all sectors, and so the economy has to react to the private sector, which is already contracting. And on top of that, you have difficulties refinancing. And in this case, this shock occurred at a time where you had already a peak in debt service. So the countries were especially vulnerable at high refinancing needs. And so that's why you see here, I mean, the charts might not be completely legible, but that's for countries that we call illiquidity risk, so that have high debt service payments, and those countries with above 20% of debt service to revenues in median, so very high level of debt service payment, so they have to contract and to go in a low growth, low investment trap. And what we want, so here we have three scenarios. The rate scenario is the one which is occurring now, where interest rates remain high, and that means that when you're refinancing, but at very high cost, and so that drags the cost of debt, the interest cost along, and doesn't go back down. Even though it could be just a liquidity crisis, there's a true risk that it becomes a solvency crisis if interests don't go down. So that enforcing countries in contracting to service the debt and to have low investments. Next slide. And so this paper tried to outline three policy options. Two that are the current alternative, or basically two options that we're going to describe. Refinancing debt as it comes. The other is restructuring, so that those are broadly the two choices that countries face. We're going to argue that there needs to be a third option that would help in this particular context. So maybe on the first one. So the first one, when when debt is high and countries can't realistically service it without contracting, where the austerity is not politically or economically feasible, restructuring is necessary, and that's true for a large number of countries that are above the levels of where you consider that the insolvency risk, where debt stocks are high. On average, is not so much. I mean, so there's a significant number of countries where it is the case, but for most, on average, for lower middle income countries, external debt has risen, but it's still way below where it was in the 2000s. So the number of countries that should go into restructuring, and a number of countries where it's not the level of insolvency risk is not that high. Can you go to next slide? And so for countries that need that restructuring, that will have demand, it's still very complicated. We know that the common framework remains very slow. There has been some progress in the latest debt treatment, going faster, but it's still very slow and relatively shallow. It's also more complex because of the composition of the creditors. With more diverse creditors, it's much harder to get people around the table, whether it's with the common framework or outside the common framework. And so that creates difficulties even for countries that would I wanted to restructure, and that creates further hesitation. So that's an absolutely necessary work, is to improve this coordination, improve those mechanisms that can rely the statutory law in the courts where a lot of international bonds are issued would help in the Court of New York, and so we need to improve this framework. You can go to the next slide. So that's option A. We can improve. There's some countries that it will help, but it's not the majority of countries. Option B is refinancing. So that's the current approach that the global financial system has taken. And we can see that very clearly with definitive data in 2022. The data for 2023 are still more partial, but there's a clear sign that it's actually getting worse. And so I'll just show you the two tables here. So the table shows you the net flow. So how much new debt was raised versus how much debt reimbursement there was in a given year by different sources. So first you see that the flows on so the net transfers on long-term debt are now negative for low and lower middle income countries. That means that there's more long-term debt that is repaid than what is raised. So that means that capital flows are going in the wrong way. If you add short-term debt, it becomes zero. So countries have been able to still finance themselves by issuing short-term debt, which in a way is increasing even more the risks. And if you look at the composition, we see very clearly that in 2022, and again, we know from the bond data on bond issuance that indicate very clearly that it worsened in 2023 and is still negative in 2024 so far. A very massive contraction, $50 billion overall that went out. And if you look at the bilateral loans, the loan from China as Chinese policy banks, which were lending a lot in the mid-2010s, are now lending much less, and a lot of projects and a lot of loans are coming due, so hence also smaller but also negative flows. That's been compensated by new loans from the international financial institutions, the IMF and the Multilateral Development Bank and the regional development banks. If we zoom out a little bit, so there's a table below, we see how it breaks between countries that we deem at different level of risk and different types of risks. For countries that have problem of debt service, so more flow that we call illiquid here, we can see that this is the case in an even more starker way. That the private flows are going out, and it's compensated by the multilateral institutions. And so that's this country that we're going to look at. So if we can go to the next slide. So what has been the approach for those countries that we've seen in aggregate number? Now let's try to understand how, if that can be a solution to the current risk. First, I mean, in a way, the IMF is a lender of last resort. It's supposed to lend when other lenders stop lending. So in a way, it's exactly the way it's supposed to work. The IMF should lend consistently. It's not the case necessarily for multilateral development bank, which are lending for development and not to meet the other obligations. But broadly, by and large, it could be a viable strategy. It's, however, very risky in this context. First, because there's lots of countries that are in that category. You remember the chart before with debt service, that's about 30 countries in the low and lower middle income countries. So that's a lot of countries where debt service is high simultaneously. Second, if those trends continue and multilateral financial institutions have to substitute for the next 4 years, we are actually, our projection starts in 2033, so we're already 2 years later. So they have to continue, they have to double the size of lending. So it's very large, and even though there is a clear program that is advancing at the G20 that is discussed here, and that will be part of the important discussion of the FFD, a clear program to increase the capacity of multilateral development banks to deliver lending and to deliver concessional lending. So that's very important, but it's not going to meet the needs. It would be both too small, even with ambitious approach, and too slow, because those flows are needed now and for the next 3-4 years. And again, it's a doubling. We have, for this set of countries, we have about 30 billion new loans every year in the past years. If the official flows have to substitute to private flows, we're talking about 60 billion. The third reason is that, and the situation's changed, I think, when markets were completely closed. They're reopening now, but they're reopening in a way where the rates are very high. So even if they come back, it can turn illiquidity into insolvency problem because the interest costs are adding up when rates are high. And there's a suspicion that it will, even if the US interest rates go down, the spreads will remain high, because compared to when a lot of those bonds were issued in the 2015, around 2015, the ratings have declined. And so the spreads and the cost of interest rates, even if the central interest rate is declining, will remain high. The last point is that when you have as you have this association of multilateral loans to private loans, the debt, the multilaterals cannot or senior creditors, and so you have less debt that you can restructure on, and so that makes debt restructuring, if there's a bad shock, if the situation continues, debt restructuring becomes much harder down the line. So what we do is to introduce and to build on the proposal that we did in January to update it to the current context. And so go to the next slide. So what we propose is basically a three-way deal where countries would get the time to invest and grow. So it's really providing time. So during which MDBs can ramp up their lending, and as we said, the other creditors would not have negative net transfers. It needs to be in a plan, a coordinated plan led by countries and so where investment is credible. That's where it's very important to have a coordination between the IMF that makes sure that there's actually that there are investment, that the IMF, the macro framework allows for more investment, and MDBs that provide the new flow that's going to go to projects that allow to grow. And finally, and that's the most difficult point, is make sure that the other creditors stay in and reschedule over a longer term. Why would I do that? I think that's the key question. First, the bilateral can accept doing that. They've been doing that. Both China, as a creditor, has done rescheduling actually frequently, not in a multilateral manner. It's also for good reasons, after the debt service suspension initiative in 2020, where private participation was voluntary and where China, the main official bilateral creditor, provided most of this rescheduling of loans. So it's skeptical that it can be achieved. So it's important to convince that the private sector will follow suit. That can not be a purely voluntary participation. How do you propose to do that? There's two ways. First, in a liquidity situation, if the country gets time and the growth and investment plan is credible, the probability of getting repaid are much higher. So there's this incentive to stay in a country. So that's really about the credibility of the country plans. Second, you can introduce carrots. You can introduce incentives to stay. So that can be under the form of guarantees. They have to remain relatively low cost, because otherwise it substitutes a guarantee can for a given country substitute to new financing loans. It shouldn't be the case. It should be relatively limited. But it can provide incentive. The private creditor would be reassured that it would be repaid in 4 or 5 years after the end of the program because of this guarantee. Third, they can third, if carrots don't work, this program should also provide incentive under the form of sticks, and that's with the IMF imposing rescheduling, and that the IMF has the tools to do that. So the idea is that if the correspondence of credibles and with credit enhancements that could provide the incentive. If those incentives don't work, further involuntary constraint can help. If you can go to the next one. So, and how does it integrate in the broader international finance architecture? I think it integrates in, there's the first bullet of the general, I think, reform that are ongoing, more investment, larger MDBs, so more financing, also more resilience to shocks, so that's the second objective, and adapting to a more complex landscape. The idea is that there's countries that don't have the time to benefit from that. We are in an urgent situation where debt service is very high and there's no market and the new sources of financing are not coming. So in this limited window of opportunity, we need to provide countries with time, and that's what this proposal does. And to end up, to avoid a systemic debt crisis, there will be a lot of restructuring needed. This can also be an option for the longer term added to the debt resolution toolbox, which for now is too, the choice is too stark between just refinancing and a pure debt reduction. I'll stop there. I'll let, I think, Martin Guzman is online to add his comments, and Isaac, and I don't know if Vera joined, but maybe Martin, you can go ahead.
All right, thank you, Martin, and thank you for such a clear exposition, and good afternoon, everyone in Addis. I'm speaking today from Buenos Aires, and it's been a pleasure to join efforts with our colleagues from the Finance Development Lab at the Paris School of Economics, Ishac and Martin, and also with Vera Songwe. Over the last year, we had a number of encounters, discussions at Columbia University, at Paris School of Economics, and also at the Vatican. And we ended up producing this joint paper, which builds on the previous work from FDL and the other colleagues. Let me complement Martin's comments. I'll begin with a description of what I consider the three tenets over which our paper builds. The first one is the recognition that there is value in countercyclical macroeconomic policies and in growth policies. We want countries in bad times to be able to implement countercyclical macro policies, and also that they need to do it in the good times as well. The second tenet is that there is a pro-cyclicality of capital flows for low income and for developing economies, which the other side is that there is a counter-cyclicality for the advanced economies. Of course, planet Earth is a closed economy, so we cannot send or receive capital from other planets. That means that for the planet, capital flows are acyclical, but when there is a negative shock for the global economy, capital flows into the advanced economies. There is a flight to quality. That means that capital leaves the rest of the world. And that makes counter-cyclical macroeconomic policies more difficult to achieve. It actually prevents countries from, the developing countries from implementing counter-cyclical macro policies. And the third tenet is that we live in a world of incomplete markets, and therefore we have incomplete contracts, meaning that we can't index every debt contract to the different contingencies that can arise in the economy. And that means that there will be certain contingencies that will give rise to debt distress. And that debt distress could turn into debt sustainability problems or unsustainable debt burdens. So in those situations, there is need for some operation. The word restructuring is highly charged, but it's a word that is often used. We more generally refer to debt operations, and we try to clarify what kind of operation would be appropriate in every circumstance. And in that sense, Martin described three possible avenues. The standard restructuring that involves haircuts to the principal and the coupons, as well as extension of maturities, not necessary with participation of other international financial institutions. The current approach, which we think it's proving deleterious, is proving harmful for the countries in which they receive positive flows from international financial institutions, meaning that global taxpayers are contributing to the countries in distress, but at the same time they have net negative flows with private creditors and official bilateral creditors, mainly China. And that implicitly constitutes, in a number of cases, a bailout for unsustainable, for the holders of unsustainable bonds or unsustainable debt. And that, as Martin put it, is not just a very risky approach, but one that could bring more troubles for development in the future. And the third approach, the one we think it's the right one for many of the countries suffering distress today, which is one in which everyone puts something. The country comes up with an economic program for macroeconomic stabilization and economic growth that needs financing. International financial institutions make a contribution, and creditors, private creditors and official bilateral creditors also make a contribution in the way of providing a significantly long extension of maturities. There may be slightly different views in terms of our expectation of how long it will take for each of the countries in that distress today to access international credit markets. I'm on the most pessimistic side. Together with Joseph Stiglitz, probably we think it's going to take quite a while for countries that are suffering crisis today in the current context of global liquidity to be able to reaccess international credit markets. So the contribution in terms of extension of maturities should be significant. And at the same time, the price for that wait should be a reasonable price, should be an interest rate that reflects the possibility of restoring that sustainability, meaning that it should be a low interest rate. Especially if we consider what Martin explained, the idea that the bonds issue in the restructurings or in the debt operations include guarantees from international financial institutions, because the guarantee essentially what it means is a transfer of risk from the private creditors to the global taxpayers. So that means that creditors should have a much lower compensation for the risk. That's why we think the discount factor used in these debt operations should be low, should be probably close to the World Bank cost of capital. In the paper, we also discuss some of the recent examples. We point out that Kenya is an example of what's not sustainable, an example that should not be followed by the countries that are suffering a crisis today. And we include a discussion on the trade-offs that are faced when international financial institutions provide more financing to low and low middle income countries. That we have to be careful with what that means for financing for middle income countries. We don't want middle income countries to be unable to access to the financing they need, also for development policies, for the green transition. So we must carefully account for these trade-offs. And finally, we have a discussion on how to affect the structure of incentives to promote participation of every stakeholder in this process in this updated bridge proposal. And in that sense, we discuss the IMF role, including the IMF policies and debt sustainability analysis. Debt sustainability analysis are key for influencing the structure of incentives of both sides, the debtor and the creditors. A sound debt sustainability analysis can alter expectations in a positive way. And we also discuss something that is actually being discussed at the New York legislature, which is the compensatory rate for securities in default before there is a judgment in the courts of New York. So according to New York law, and New York law is very important for these countries because a significant portion of the bonds are issued under New York law, the securities in default yield an extra 9% as a compensatory rate until there is a judgment. That rate was set in 1981. When inflation rate in the US was, the annual rate was 8.9%, then inflation came down and that rate never changed. So there is a very high yield, a high compensation for private creditors when they hold securities in default, and that may distort their incentives. This is something that implicitly has also been raised by the US Treasury in the statement by the Undersecretary Jay Jambo that was released last April. And there is very good work and efforts that have been done, including I see Aldo Cagliari in the room from Jubilee USA, that has been done over the last year. And we think progress on that front, a change in the next semester early next year would contribute. It would be a significant change for enabling the kind of solution we are proposing. So we look forward to the discussion. I'll stop here and I'll give the floor to Vera.
Actually, Vera is in Rio driving. It may be.
Okay, so thanks a lot. So maybe let's give the floor to let Vera finish driving and give the floor to the discussants. So I have 3 discussants today. We'll start with, so to stay on the screen, Alemayehu Geda from Addis Ababa University, who provides a perspective from an African perspective and Ethiopian perspective. Alemayehu, on your line? There? Alemayehu? If you can, for 5 minutes.
Good. Thank you very much. Thank you very much. I wish I could join you. I'm in Cairo at African Export-Import Banks. I have my 5 minutes point is this. We did a study, a detailed study of the debt problem in Ethiopia. And we also did a continent-wide study of the debt problem. And pretty much what we found is the kind of issue that is raised in this bridge proposal. In Ethiopia, we did, the drivers of debt, the institutional problem debt, and also the effect of debt, and pretty much concluded that the Ethiopian debt problem is essentially a liquidity problem. And the kind of bridge proposal that you guys are doing is what is important for countries like Ethiopia. And in fact, we presented that to the Ministry of Finance. The minister was there and he completely agreed with us. So I want to say that this is in line with, in particular, low-income countries. Now, the second point, also, I did also a similar study with UNCTAD in 2022 on Kenya. And we pretty much anticipated what will happen in Kenya if the kind of proposal that you did is not in place. And it turned out that's what happened. But we also concluded that the international environment, it's not only Kenyan government, but international environment and the international financial architecture need to change to enact the kind of policy recommendation you did. That was pretty much what we also concluded on the study in 2022 with UNCTAD on Kenya. Now, this has implication in Ethiopia, for instance, the debt service has become really very heavy to the point that we cannot pay anymore. In the sense that, like last year, the spending was combined education and roads sector spending is smaller compared to the debt service. This year's budget, if you see this year's budget for debt service, it is larger than the combined spending on education, health, road, combined together. It's huge. It's again the top. So it's a major problem. And we also found that there is no working on green issues and addressing debt issues are not mutually exclusive. And the sense that in a study we did with Global ODI, we found that the kind of structural transformation Ethiopia wants is compatible with investment in green and addressing the debt problem at the same time. So that would be also a very important issue. And finally, probably what I didn't see in the paper, I don't know whether we have to discuss it or not, but very important is that the last presentation when the colleague, the last presenter speaks, he speaks 3 things: that there are things that creditors need to do, there are things that multilateral agencies to do, and there are also countries. There are things that countries to do. The countries, they are expected to come up with with a growth strategy that will be compatible with the bridge proposal. Now, probably what you guys didn't discuss what that growth strategy is. Invariably, from countries, that will be eliminating, I guess. That's pretty much what I have. Thank you very much.
So, I feel sorry because the internet slightly cut when you were coming to the critical part of the paper. It was not on purpose, but maybe let's try to come back to this. I mean, I think we got the point that we need to emphasize more on what we mean by a growth strategy, and I think that's indeed extremely important, extremely central to the paper. So I'll pass now the floor to further discussants who are here in the room with us. It's two former central bankers, and so to discuss fiscal issues. I think that's perfect. And I want to thank both of them for accepting to join the last minute almost. And so first, I will ask Reza Bakir to speak, now with Alvarez and Marsal, and former governor of the Central Bank of Pakistan. Yes.
Well, it's always a great pleasure to discuss a paper of 4 people or 5 people, I forget how many, who are all co-authors and friends. So if I look at Ishac and Martin and Vera and Martin, so thank you. It's a great pleasure to do so. By way of introduction, as Martin said, like my friend Patrick over here, I used to be the governor of Pakistan Central Bank. Before that, I was at the IMF for 19 years. And 4 of those years, I was the head of the IMF's debt division, the debt policy division. So these matters are dear to my heart. Now I am a managing director at Alvarez and Marsal and run a global practice on sovereign advisory services. I have 2 comments for the authors. One is a suggestion around how to communicate the proposal. And the other comment is around the content of the proposal. Let me just begin by saying I really enjoyed the paper. I think it's great work. And more than that, I really commend the zeal with which Martin, you, Ishac, Martin, Vera, others have been pursuing this line of research, if nothing else, to call attention to the need to do something. My comment around how to communicate this is the following, and it could just be that I may not have understood the proposal very well. I apologize, I didn't read the paper, so I'm going by your presentation. But I was taking notes as you were presenting, Martin, and you laid out 3 key elements of this. I'm talking about option 3, okay, the bridge, the updated bridge proposal. The first is that the country invests and grows. The second, that the MDBs scale up in a coordinated manner. And the third, that other creditors reschedule. Yep. All right. Now, when I read this, I see this, the question I have is, how is this different from any IMF-supported program where the IMF has decided that it cannot lend unless there is a debt operation? Because the goals of the IMF program in such circumstances increase investment, multilaterals will step up, and the IMF is requiring the country to do a debt operation. This is not how all IMF programs are, for sure. But in the minority of programs where the IMF has made a determination that debt is not sustainable or not sustainable with high probability, depending upon how much the IMF is lending, then it will require. So my question, now, I don't think what you are calling for is that for the IMF to become more tough on countries and to start calling for restructurings very proactively, even if the IMF is unsure. I don't think that's what you're calling for, but I think it will be good to clarify how this proposal is different from any IMF program that is essentially calling for a debt operation. Because, the IMF would have to be part and parcel of any such program to go forward. So that was my comment around how to communicate it, and it was made just if it's helpful. If it's not, please ignore it. My second comment is around the content. And here I have two points. The first point is a point that I had also made on the Sunday session that Cherry and others had organized on the debt as part of, I think, some other work stream. I don't understand all the UN work streams, but the point I made over there was that, you know, in any proposal where you make it mandatory for the debtor to require a restructuring of private creditors, there is hesitation to participate in such a program. I can tell you from personal experience, when the DSSI was presented to the then finance minister of Pakistan and me as the central bank governor, we were very clear that if we had to go and ask private creditors for a restructuring, we would not have participated. And only when we were assured that we were not, that we said, sure. With that, even with the fact that imposing a restructuring on private creditors was not required, participation was, I think, only 1/3 of eligible countries in the DSSI. Now, if as part of this proposal, it will be required, as I think it should be, because official resources should not be put without requiring, you know, comparable or proportionate effort from everybody, it would be harder. You don't want to build a beautiful car and then have nobody want to drive it. So there is a need here for debtor coordination. And I think it's good to think about how would that be achieved. And I think that's part of the content of the proposal, because you want to think about how to make it happen. And the other day, I made a suggestion of trying to get, you know, a few countries together that overcomes stigma. Then it's not a problem of one country that is defaulting on its obligations, but rather a country participating in a program. Happy to talk more about that if helpful. My second comment around the content is going back to your very first element, which is countries invest and grow. I think if any such thing is done this time around, and I think it should be done, okay, the bridge proposal is something better than the status quo. In my view, it should not happen without a different way to address this first element of ensuring that the freed up resources actually go towards investment or go towards the purposes that they are intended for. Typically, ex post accountability or ex post audits are not good enough, because by that time money is out of the door. And I think this time around, if anything goes forward, it has to have live monitoring and reporting by independent entities, whether they are private sector, but independent because they can't be a debtor and they can't be a creditor to avoid conflict of interest. Such independent reporting and monitoring has to happen. Otherwise, you run the risk of just debt burdens piling up, because this borrowing leads to more debt than to growth. Thank you.
Thanks a lot for that. I think the excellent points, and happy to enter the discussion just afterwards. Now, just before the last discussant, Patrick Njoroge was the former central bank governor of Kenya, and very kindly accepted the invitation also on a very short notice. And he told me if I come, it would be very critical. So I hope you won't disappoint us. Go ahead.
Thank you very much, Martin, and colleagues, and those coming online. Reza, old friend, well, still a friend, still friends. So anyway, it's great to be here, and I'll try and be rather quick. So I'll try and go quite quickly because I want to cover a few things. But the first thing is a disclaimer. I'm from Kenya, all of you know that, but I'm making my own comments, and they are not associated in any way with my former employers, the Central Bank of Kenya or the IMF. So completely the good, the bad, and the ugly is mine. And then the second point is the second disclaimer is the paper mentions, particularly the revised paper, mentions Kenya in some places, and Martin Guzman did mention it also, and I will not comment, and my comment on what I'm gonna say, I'll literally scat that, okay? That's not my place to comment. Fine. So on the specifics, first, I think the paper, it said in a previous edition that I read, it's like maybe, I don't know how dated that was. The last paragraph said something like, we are contributing, it's contributing to highlighting a gap and opening a discussion. And I really think that this paper has done exactly that. So all of you should be commended for making, beginning to discuss difficult questions. Secondly, in there are some, I'll call them financial engineering sort of proposals. And I think these are all good. The guarantees, the interest rates, all those things, the swaps, all those are good. But and I think there are many more proposals that can be put on the table. Those do not span the entire knowledge of financial engineering that is even in this room. So I think that should be encouraged, but I think the issue is to place it on a sort of on a solid foundation or solid backbone. So I come from a country of runners, marathon runners, okay? I know there are several Ethiopians in the room who will contend that. We can take that outside, okay? Actually, we're going to take care of it in a few weeks in Paris, okay? But I'm sure all of us in the room can run 5 kilometers. I mean, for sure. I mean, we can all go out there and run 5 kilometers. Maybe you win a prize record, but we can do 5 kilometers. But if I said, okay, we are going to run the marathon, and the marathon is just 5 kilometers, 7.5 times over. You know, you'll sort of say, whoa, wait a second. Because a lot of people have died. As a matter of fact, the first guy who ran the marathon died. So the 42 kilometers is not just 5 kilometers multiplied by 7.5 times. And this is my biggest concern about this proposal. It talks about climate change, it must be done, etc. And therefore, we need to have a bridge. There is a bridge proposal to deal with the current crisis and then sort of wait for efforts that will deal with saving the planet. We don't touch the issue. The proposal doesn't touch the issue of the planet, you know. And already there are proposals on the table as to what is needed in terms of financing need, the 1 trillion per year or whatever it is for climate or climate finance. We can discuss how those numbers come up, but that's not for this, right? For this conversation. So in effect, we'll be in a holding pattern for something that we don't know for how long, and for something that is bigger, and we'll have to deal with it down the road somehow. I think we should think about this. If you are not beginning telling me the plan is a marathon and therefore we are going to plan correctly, I'm going to train for the marathon, not for the 5K, for the 42K, then we can deal with it. So the fact that we are leaving all that out, in my view, is a major weakness for this paper. As a matter of fact, the way the numbers come up, the 30 that you propose or the 25, et cetera, the liquidity versus, let's say, the insolvent ones, et cetera, really is driven by the DSAs that you have done, and Reza knows that. He breathes, and I mean, other people in the room as well. But the point is that the DSA in that is therefore very, very unrealistic, because you're not loading in the financing needs that we need in the next 5 years, even to begin with. So you're assuming sustainability, but actually, if the countries go ahead and begin borrowing, or, you know, domestic or externally, for climate and even for development needs, you already blow your DSA again. So to me, that is a major issue. The first point of change has to be the DSAs. Those have to be done correctly, loading in the needs that are there. That's my sort of first most important question. Secondly, I want to make the point that this thing of illiquidity and insolvency, I think we as economists talk too much about it. Yeah, and to me, it doesn't make sense. Maybe we haven't talked enough about countries. We only have 190 countries, 90 plus, yeah? But if you think about banks, that division between illiquidity and insolvency, you only find out about it much later. So when a bank is coming into problems, you know, you generally say, well, okay, fine. If it is insolvent, you deal with it in a particular way. Or if it is illiquid, you deal with it in another way. Yeah, if the problem is liquidity, that's when you do your lend of last resort. The point is that that is artificial. That sort of division is completely artificial, and you'll never know. It's only after the fact that you can sort of figure out what those, and frankly, even for something that you think is insolvent, you can create a scenario where it is solvent. Yeah, this is what good bankers do. And then they try and run circles around, you know, central banks. So I'm making the point that that is a distinction that I don't think makes sense. I want to make a harder point, which is something, if there's one thing that I want to make, to sort of emphasize is that, you know, no government in their right mind will ever call for default. There's a lot of people that sort of say, well, you know, let the country go into default. You know, why is that? It's not irrational, yeah? Reza just grazed over that. The reason is that is a hard, you know, that's a hard, decision. There are certain things that are hard in life, okay? So you don't know, so you begin with that, you don't know how it will end up. So there, in a sense, you're beginning in using, well, various terms that some of you know, known unknowns. So when you do a debt, if there's a default, if you declare default, you know that, okay, fine, you're declaring a default. So there's a known unknowns that will come up. But the danger is the unknown unknowns. You're going into a tunnel that you have no idea what will happen. And I ask you whether Zambia knew that they were going to put their country in deep freeze for 3 years. And if now that they know that, if they would be willing to do it again. Yeah. Now it wasn't just putting the country in deep freeze. It's just that the pain that the population went through. So I think we need to be more, maybe we may not accept it, but we should at least listen to that. It's not an irrational thing. There are also many things in life and in things we deal with that you can say are hard decisions, right? I'll throw some just to be argumentative, right? I'll throw some at you, right? So think about the things about compensation of things, right? You have contracts, for instance, that were signed 80 years ago or 60 years ago in Africa. Yeah. Even military contracts. How come it's so difficult to undo those things? Because they're hard decisions. And those hard decisions come with unknown unknowns that we don't want to go there unless we have absolutely no choice. So I hope I've dissuaded you from this sort of, in my view, flippant sort of statement that is, well, let them declare default. That's the best decision that they could make. I think it is the worst decision they could make. I want to move on quickly. I've already made the point about the DSA, etc. But I want to make another point that we are already in the worst crisis in 80 years. And the paper, in some sense, not because, maybe it doesn't come out that strongly. I think the danger here is that we move quickly on something without realizing how dangerous this space is. And the issue isn't the debt alone. It is the development crisis that we have. I think, Martin, you mentioned it in passing, but that is, to me, the major issue, that health and education has been sort of pushed out, spending on that. And that will have significant, let's say, costs down the road, even on other, anyway. So my point is, this is why you cannot leave out that element of the development cost and indeed climate change. We have to make the point again that if we do nothing about climate, it's a death sentence for a lot of our small island economies and a lot of other, let's say, communities that we have. So it is important to deal with that. Now, I want to, in passing, make a point that there is a paper that I'm part of a group, DRGR, Debt Relief and Growth Initiative. It's on, which tries to capture some of these things. And it shows that about 66 countries will be, according to the IMF's definition, either in will have serious debt issues in 5 years. And so it requires a much more ambitious debt relief process than is proposed in this paper. I want to finish. We're in a holding pattern. What do we need to do? So I think the issue here is to be more ambitious. We need to be more ambitious. And I think in some sense, let's go back and deal with some of these things. We need a sort of a concerted effort that deals with the future needs, a sort of a HIPIC type thing, yeah? So you don't have these countries coming in sequential ways like Reza and others have sort of not suggested, but mentioned in your comments, right? A country that is in distress or whatever, they come in, sorted, then move out. So the common framework sort of approach. No, let's have all countries and get all donors, all 190 countries and donors, and then do a sort of a complete thing. Also bearing in mind where we are going, which is the the financing for climate and development, and then we can know what level of debt relief is needed to make that work through. Today, we don't know. We can just guess. So in the paper, there's a 15%, which, yeah, it's true, there's a footnote that says that that is just for illustrative purposes. But I think the point is the ambition needs to come through. I finish with a quote that to tell you that, to mention that actually the pressure today is not on debt. Make no mistake. It's not debt that actually gets people out on the streets. It is things about development. It things about their lives and livelihoods. Things about, let's say, health or other things. That's what gets people out there and, even putting their life on the line, as we've seen elsewhere. So I finish with this quote: young people are no longer asking, and neither should we, young people are no longer asking for serenity to accept the things they cannot change, but instead for courage to change the things they cannot accept. Let that be the principle of our work. Thank you very much.
Thanks a lot, Patrick, for this call for our ambition, and I think very good challenges. So we have, I think, 10 minutes, which is short for discussion and Q&A. We'll see if we can, I don't know if you can stay looking at the UN a little bit more. Some people have to leave because there's another meeting, but if we want to continue the discussion a little bit, we can. So those who can stay, I think, can stay in the room. So maybe Ishac, do you want to take some of the comments?
Yeah, I want to try. Our proposal recognizes, as Patrick says, that countries don't want to default. And 66 countries to default because they need space, they need headroom in order to be able to borrow in the future. I think this is going to be tough for the common framework or any other framework to digest at the moment. So we're trying to come up with something a little bit more realistic. And that's why in the proposal, we try to actually compare the status quo of bailing out, not enough of a safety net, or a debt reduction strategy of the type that you described, Patrick. And so, you know, we come up with the notion that we need to land somewhere. And if we can grow out of the debt crisis, then at least we can avoid a systemic debt crisis. We can be in a situation where MDBs can scale up. Concessionality as well. I mean, some of this debt would need to, some of these flows would need to come as grants, as concessional debt. They don't all need to come as expensive debt. They should not. And number two, they should, as Reza said, we need a lot more progress in ensuring that these funds allow countries to grow out of debt and therefore not to require much more headroom for the new financing. Now, I simply want to say one more thing. There is an urgency here. I mean, I completely agree with Patrick and others around the table that say the house is on fire. And we're talking about long-term saving the planet. We need, first of all, to save the house before we can save the planet. And so, you know, we could have very ambitious proposal while the house is burning, and that's not terribly useful. We cannot anymore ignore the fact that commercial debt is 40% of total debt right now. And so, you know, any solution requires private creditors to share part of the burden. We're in a situation where that could be done by making space, not withdrawing. And that's the key, it seems to us, the key challenge. And that's what our proposal is about right now. I give the floor to someone else. I know the time is very short, right?
I could
very
come in.
scarce. Vera can come in.
Yes, no, thank you. Thank you very much, everybody. I'm in Brazil. G20 meetings, we're discussing a little bit the proposal as well and trying to see how we take it forward. I really welcome and thank all the comments that have been made. And, you know, this work we started with Ishac and Martin and Martin, two Martins, and Joe now with post the Vatican, really to see how we can begin to bring together different views and very true, Patrick. You have seen different iterations of this proposal. I want to say three things given the time. The first one is about growth. I think that one of the things we wanted to be very sure and strong about was that countries need to grow. We are not going to get out of sort of this morass that we are in because somebody did debt forgiveness. We're going to get out of it because we grow. And so essentially a lot of the conversation that we've been having for the last 3 years almost now has just been about debt. And the question about growth must come to the table. But we do have an opportunity because we have climate, and climate allows us to actually devise growth strategies that will be consistent with bringing down our debt and growing sustainably. So that's the first thing. I kind of a little bit disagree with Patrick on the solvency liquidity issue, because on the liquidity issue in the corporate sector, if you have a liquidity problem, you can actually go to a repo market and get, you know, some resources to sort of stave off your liquidity in the short term. We have seen in the United States and in the developed countries, huge liquidity injections into the system to stave off essentially insolvency. So there is a huge difference between the two. And I think that is what we are trying to do here, is to say, we have to diagnose the problem well. There are countries like Nigeria, debt to GDP is 30-something%, but huge debt payments coming due. Are they insolvent? No. Do they have a liquidity problem? Yes. Can we solve it? Yes. And so essentially what we are trying to do is say, can we maybe segment, particularly in an environment where we say that we don't have enough of the resources to go around, can we solve it in a way where we segment the countries that have liquidity issues? Let's solve those ones so that we can give the either resources and whatever to those who really need them. So I think this is the distinction that we're trying to make, is if this illiquidity countries are also growth enhancing countries, taking and putting in place the right reforms, then we can actually treat them differently and separately. I fully agree this paper is not, and if there is any indication or any sort of implied space somewhere, we'll go back and look at it again, that we are saying countries should default. We are not asking countries to default. On the contrary, what we are saying is that the market is not trusting the IMF and the country's growth plans. That's why Kenya went to the market at 10%. The market trusted Ivory Coast growth plan. That's why Ivory Coast went to the market at 7 point something, because they had, of course, 7 point something is high, but US interest rates are 5. So essentially it's 2 point something on top of the US interest rate. That is what we are looking for. And so essentially when we say the private sector has to give something, is to say, if you're going to the market at 10%, there is an implicit message there from the market. And I think if you look at country, market, IMF, the only honest person there is the market, because actually they're investing their money. They're not investing taxpayer money, and it's not free money. It's their money, and so they have to send the right message. When they ask you to come to the market at 10% and above, they're not trusting somebody. They're either not trusting the country, or they're not trusting the IMF, or they're not trusting both. So we need a good growth plan, first of all. If we can get a good growth plan, then you begin to get the markets that say, fine, we will give you the resources that you need, even to pay us back, which is what Cote d'Ivoire did, but we will give you out of space that allows you to be able to continue to grow as you do that. That is what Senegal did as well. So I think we keep talking about the bad cases, but let's look at the good cases and hear what the market is saying to us, and ask ourselves, as the development committee, are we actually honest about our growth projections? I think we all see now in Kenya the conversation around when the growth projections the right one, that effort was being asked of them the right one. And essentially we do these models that end up with the market not trusting the feasibility of it. If you haven't done it for 20 years, you're not going to do it in 3 years, essentially. And I think that is really the proposal that we're trying to make, is give us a credible long-term growth strategy, most very relying on a green growth strategy. Then you begin to get the private sector, because everybody now says, oh, but the IMF and everybody is waiting for the private sector. The markets have opened. Senegal has gone, Cote d'Ivoire has gone, Kenya has gone. So the markets do business because we come to them. So they will come. They will just pay us what they believe we're telling them. If we're not telling them the truth, they'll charge us 12%. If they believe we're saying more or less something, okay, you know, Benin is in the middle, they gave them 8%. So essentially the market is open. What we need today is for the development segment to say, okay, the market is open. How can we make sure that when you get to that market, you are facing a reflective growth price for going to the market? We also see China doing things helter-skelter. They're doing something with Angola, they're doing something with Ethiopia, but if we were able to build a coordinated process, then we will do the same thing for Angola, for Kenya, for Ethiopia, for Cameroon, for Cote d'Ivoire, and for everybody. And I think this is the coordination that we are still waiting for the official sector to put in place, that they have not yet put in place, so that the rest of the system can work. So, and I end here, is one, we are not asking for defaults, because defaults don't work. The market is not asking for defaults. The market is open. What we need is a credible growth strategy that is built between the fund and the countries. And maybe that when we start doing the DSA, and I'm so happy, Patrick, that you mentioned the DSA, that we start putting a real rate of return for every debt that is contracted. All this sort of, well, let's go and put some NGO to put it in a website, doesn't work. If we give the IMF the obligation that for every growth point that you assume in your growth projection, you tell us what the rate of return on the investment that you're assuming is, I think we begin to get transparency, because we begin to follow the projects and say 2 years later, is this project still happening? Is that growth rate still the same? So you get transparency, you get more investment, and you make sure that these countries can grow in a sustainable way.
Thank you.
And Reza will take you into account. I think there were some really good ones there that we should for sure look into.
Thanks
and
a lot.
What we're hoping at Brazil, that we can find 5 countries that are willing to work with us to sort of see. I think the US and the G20 group is now sort of trying to support this. We need 5 African countries that come behind, and we sort of put this together and go forward. So if there's any people in the room that are interested in sort of offering their countries that we can work together with you to see how we go forward, we would be very happy to undertake this effort with Colombia, FDL, and ourselves for sure. Thank you so much.
Thanks a lot, Vera. I think we will have to close soon. I'll give the floor to Shari, speaker for a question.
Thanks so much, and we have to leave to another event really. So really quickly, though, I just wanted to say three really quick points. First, thank you so much for the paper. I really thought it was important where it said that the private sector, that's the hardest part, because not very long ago, both at the IMF meetings and then actually at a meeting at Colombia, the private sector participants were arguing very strongly, and certainly IMF colleagues were agreeing that that the private commercial creditor part had been solved. And so I think it's really good to change that narrative and to really highlight again that it's actually one of the, to put that back on the table as one of the most difficult parts. I think that when we're talking about, I think there's a lot of narratives coming together that are saying very much the same thing that's reflected in the bridge proposal in many ways. And the question that I think we have to answer, and I wanted to take the floor to bring this to FFD4, is then what's the solution? So if we want to say we have to bring the private sector in, we know they, as Reza said, they do not want to default, countries don't want to default, and they don't want to be calling default. Then if we want to bring the private sector in, how do we do that? And what is the structure? Do we need an institutional home to, what is the institutional structure? What's the next step in this? And because that's something I think we can take to FFD4. And finally, I want to just add something. At our meeting on Sunday, the civil society colleagues brought up the question of some sort of a framework convention on debt. And the reason that an area where I think it might be quite interesting is particularly thinking about some of the domestic legislation issues. You know, what does a model law look like? And then could there be agreement across countries to implement some sort of law? And I wonder if that's something, because they're the carrots, but there also might be the sticks, and the sticks may be having stronger legislation. And we know we can't get a global legislation, but maybe there's a way to think about, this was actually in the Addis agenda talking about national legislation. And again, so I wonder if that's something that can be further explored. And the final comment I want to make is on this question of liquidity versus solvency. It's certainly a difficult question. I sort of agree with both sides. But because the markets, it depends on, the risk is in the eye of the beholder, and so it's a very difficult question to answer. But I do think, and I said this at the meeting on Sunday as well, that when I was investing, we had way before DSAs existed. In fact, there's a funny story where Timothy Geithner, when he was at the IMF, asked us for, because we had our own internal DSAs we used, back of the envelope, no growth projections, running 500 simulations under different growth projections. And Timothy Geithner actually took our DSA projections and went to, but the models we were using, but but I will not take credit for we used to run them to see what the debt path looked like. So under what scenarios did the debt paths go like this? Under what scenarios did it go up and continue to constantly go up? And under what scenarios would it start going down? And I think an interesting thing to do is to look at the DSAs for all of their faults, to run them the way they're run now with whatever interest rates are being run, and then to run them using like US Treasury rates or World Bank rates. Because if we can see the difference between what the projections are under those two scenarios, we at least can get a good comparison of what the cost is due to the interest cost, how much of the debt burden is due to the high cost of interest versus other factors. So thanks so much, and apologies that we have to run a bunch of us actually.
Thanks a lot, Shari. And thanks a lot, Pascal. What I suggest, I don't know if it's like we can maybe take, before closing, to give a bit of basically the floor, take 3 questions, give back allow the participants to answer, and then we'll close. So I have one here. Aldo, Zaisha, please. It's good.
Okay, thank you very much. Ali Zafar, Economic Advisor, UNDP, based in Addis. And just 2 quick points, and I just wanted the feedback. One is we've been advising government on debt. And so Alemayo pointed out the problem of liquidity. It seems, and I think Martin has written about it, DSAs seem to be plagued, A, with an optimism bias, B, with a very quick fiscal adjustment, and C, with lack of an assessment on future shocks, whether climate or commodity shocks. How do we modernize the DSA? One. Second point is, there seems to be 2 kinds of trust deficits in the current architecture. One is the deficit between debtors and creditors. Debtors, creditors don't want to do HIPIC because they think it's moral hazard. Debtors think creditors are insensitive, one. Two is what we've noticed in Africa is a new stress. And the new stress is between the official creditors and the private creditors. So in Zambia's case, and we might see it in Ethiopia, is that the private creditors are willing to do a debt write-down, but they want a lot of upfront cash. The Paris Club in China are wanting to do maturity extension, and they don't trust the private creditors. So we have, like, imagine Spain, a football game with no referee. We have a kind of Wild West. Thank you. So I just wanted your comments on how do we get the private and official creditors together? Thank you.
Thank you. Two quick points. Thank you, everybody, for all the presentations and the very good points. So Reza was raising the point of if this means, the IMF getting tougher, asking countries to restructure. But I want to say, is it too bad if the IMF were to ask countries to preemptively restructure? Because like up to 2 years ago, the IMF was doing that after the pandemic, and we actually welcome that because it is good to restructure preemptively, and that doesn't require a default. You don't need to default to restructure preemptively. And many countries probably should be encouraged to do that. And precisely one of my concerns about the proposal, the bridge proposal, is isn't it actually incentivizing countries to gamble for salvation, as Carmen Reichardt says, for a longer time, to eventually have to still default, and because no country wants to default, that's why eventually everybody postpones that decision until normally in most cases it comes too late and at a much higher cost than it could have happened. And second, the investments. And I salute the point about making sure that the investments will go to fund growth purposes, but we also know that it's not only up to the countries and to their capacities to make sure that they grow at that rate. There is an external environment, and for what we know about the external environment now, it isn't it's suggesting that countries can grow at a much higher rate than they historically have done. Probably even the opposite. So can we expect that countries will grow at a rate high enough to actually grow out of debt just because they get this additional investment? Thank you.
Thank you. I want to elaborate on what Aldo just said about growth and also on what Patrick was mentioning. If there won't be debt relief as part of the proposal, and it's to provide a solution of the illiquidity with more loans in this context of crisis, how likely it would be that countries to wait for 3 years or probably more to start growing in this context? And linked with this, there has been, in these days, we have heard several data analysis about illiquidity or insolvency. So some of the data that we heard in the past days from the Debt Service Watch and the Norwegian Church Aid report mentions that only 17 countries do have a temporary liquidity problem, and 99 countries instead have a long-term liquidity problem. So what are under these proposals, how many countries do you expect to be benefited by this proposal? Have you made this distinction about temporary liquidity problem and long-term liquidity problem? And do you have first selections of what would be the first countries under this proposal to be benefited?
Maybe Martin, because you didn't have the floor afterwards. Martin, if you can take the question that we want and even respond to the panel, where I think we have to leave the room pretty soon, so please be short. I would give Martin, then Alimayu and Isaac maybe to close.
I understand, Martin. Thank you. Thank you for the very thoughtful and wise comments, and especially to the discussants, but to everyone. So let me address quickly 3 of the several comments and questions that were raised. First, on Reza, what's the difference with how is the proposal different from IMF programs? I mean, we wish IMF programs always worked in a way that they allow for countercyclical macroeconomic policies and do not undermine growth, actually, that they promote growth. So in this sense, we think IMF programs should be aligned with the tenets that we have described in our proposals. At times that may be the case, many other times it hasn't been the case. In this particular juncture, the specific way in which the problems are addressed depends on the characteristics of the situation, which is different for every country. But certainly there will be countries that need debt operations. At times they could even include restructurings when the problems are too deep. And this relates to the other issue on liquidity and solvency. This is a long discussion among ourselves. And we try to be careful in the way we put it in the paper. We said countries that, given the stock, the debt stocks they have now, would be solvent or would face sustainable situations if the financing conditions were reasonable. But in the absence of financing, then the debts turn unsustainable. So we recognize that the distinction can't be that neat. But at the same time, we also recognize that there are countries that are facing lack of liquidity with debt stocks that for any of the countries that do have access to liquidity are totally manageable. So that's why we wanted to bring these 2 concepts somehow together, but at times distinguishing them a little bit. And finally, on the defaults, it's of course better to avoid defaults, but the problem is at times it's just impossible to avoid it. That's also why we push this kind of proposal. It would be better to avoid defaults, but that requires participation of the different stakeholders, including the private creditors. These bonds had significant risk premia, which is basically a recognition that there will be occasions, there will be circumstances in which the debtor won't be able to make the scheduled transfers to the creditors. Otherwise, there will be no need for risk premia. The rate should be the risk-free. So once we recognize that there is a compensation for risk, then restructurings or debt operations are part of the environment. And the cause of default many times happens before the default occurs, when the country loses access to credit markets, but also there may be exposed defaults, including reputation costs and litigation costs that would be better to avoid. But again, it's not possible in a world of incomplete contracts to completely dismiss that possibility. These countries borrow in foreign currency, and sometimes they just don't have the foreign currency. So that's why it's so important to face a solution. We chose it in the title, we said towards a solution. Why towards and not just a solution? Because it requires the participation of creditors, and that's voluntary. But we hope the set of incentives, the structure of incentives can be affected in a way that leads to participation.
Alma, you want to take
just one minute point. Vera raised an important issue that this issue needs to be discussed in the context of a growth strategy. And one of my questions was what kind of growth strategy are we expecting from debtor countries? I think that needs rethinking, both in terms of growth strategy and in comparison to the typical IMF program. That's number one. Number two, DSA analysis, Patrick also mentioned. I think I did a paper, I put it in the chat if anybody is interested. DSA analysis doesn't reflect the fundamental issues African debtors are facing. And Ali mentioned that. And I think that also needs, as part of this architecture, revising the financial architecture, it also needs revision, I would suggest. Thank you very much. Ishac, go ahead. I'm done.
Yeah, well, thank you all. I think this was really a very rich session. I think the comments reflect the existing tensions in the existing situation. I mean, this is you know, we do these DSAs recognizing that it's a problematic tool. We also work on how to reform it, but our use of simple ratios basically suggests that about 30 out of 68 countries that are liquidity constrained in terms of short term, that is, they have a wall that they need to pass, and if they pass it at low enough interest rate, then the debt would come down, and if they are growing as well, if the flows are used to grow. We calculate about 17, 18 countries are kind of above certain threshold, and we could call them insolvent. And so we think there is a group of countries that can be salvaged with enough focus. Now, this focus is scaling up MDB flows into not a short-term 3-year austerity program, but a longer program that is growth-oriented, where the World Bank and the IMF coming together and commit flows over those 5 years so that the strategy can be made credible, with, of course, the support of government, a la HIPIC, you know, talking to civil society, putting together, committing domestically to a plan that's credible, you know, with kind of democratic consultations, if you like. And indeed, then the IMF will have to ask for flow relief. I mean, why would the MDBs put their money if all this leaks to private creditors as it's happening today? It's not feasible. And so the IMF will have to be more active, as described by Reza's beautiful board paper of a few years ago at the IMF, the famous paper that was called Too Little Too Late, that asked for the IMF actually to be more ambitious early on and called for flow relief to allow countries to grow out of debt. Just to conclude, I think it'd be very useful if the UN puts together a working group where the various groups, including us and others that do projections, come together and exchange views so that we clarify whether, you know, why projections are leading to different results. I mean, sometimes it's assumption, so we just have to clarify this. I think that would be very useful in at least you know, strengthening the rest of the discussion in the future. Thank you very much.
Thanks to all for in the room, online, and have a good rest of the conference.
Thank you.